Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Welcome back. I'm Hayden Brain, and you're listening to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Damien Bisserier is a managing partner and co-chief investment officer at ARIS, Advanced Research Investment Solutions, a $19 billion investment advisor. Damien has over 19 years of experience advising some of the world's leading institutional investors. Damien spent nearly a decade at Bridgewater Associates, one of the highest profile hedge funds on the planet, founded by world-famous investor Ray Dalio. In this role, Damien was responsible for managing relationships with the company's impressive list of clients, an array of family offices, foundations, and pension mandates ranging from $1 billion to $100 billion in size. We discuss why risk parity strategies are effective in today's market environment and uncover why some risk parity managers missed their long-touted chance to record significant returns amid the pandemic's volatility. We conclude by examining ARIS's industry-first Risk Parity ETF. Enjoy the interview.
Welcome to the podcast, Damien. It's great to have you on the show. So how's your week been so far?
Good. Busy.
Yeah, I can imagine it's the same here. All right, well, I want to get stuck straight into risk parity strategies and kind of the efficacy of them in the current environment, that sort of stuff. And as our listeners know, we like to get into the most interesting topic of the podcast. We circle back to cover your background, to introduce you to the listeners, and then we'll get into that topic in greater detail. So that's kind of the typical format. So let's kick off. In what was arguably the perfect, in inverted commas, environment for risk parity strategies over the last 12 months or so, why do you think so many managers in this space were actually unable to outperform the market?
It's an interesting observation. Just on your first point, that it was a good environment for risk parity in general. Where I think risk parity really demonstrates its value is in rapidly changing economic environments. When you have particularly negative surprise environments like we had in Q1 of last year, risk parity has a significant allocation to assets that are actually biased to do well in that environment. And so contrary to the conventional asset allocation, which is largely allocated to a single asset class, which is equities, which clearly has a bias to underperform in that environment, you have a fairly large allocation to assets that are actually biased to do well. And actually in that environment, we found certain assets were in a bull market when equities were in a bear market. So you're absolutely correct that last year was a great example of the power of risk parity and the power of diversification and why that's so important in portfolios. It's an interesting fact that many risk parity strategies underperformed, and it's related to the fact that risk parity strategies typically target a specific volatility. And when you get into an environment like March, when market volatilities spike, those strategies mechanistically will reduce their position sizes in order to continue to target that certain level of volatility. Maybe it's 10% is a pretty typical level. And the outcome last year was many of those strategies then experienced significant underperformance by virtue of being underexposed to the rally that happened subsequent to the middle of March. So they were essentially underexposed in late March through, call it the summer, when markets had that really impressive rally in Q2, and they were overexposed during the Q1 sell-off. And it took a lot of those strategies the full year or most of the full year to recover. And that was the primary reason why many underperformed. It's really that volatility targeting or sort of dynamic risk allocation that they had, and that just was a tough environment to have that type of dynamic risk allocation. But if you just had a more static allocation like we did in our strategy, you actually saw a pretty quick snapback and very attractive performance for the year. So that was one of those environments where you needed to be in the trade and you needed to have those positions on in size throughout the year to really gain the benefits of that diversification.
Yeah, absolutely. And your kind of more static approach that you referenced there obviously gave you superior returns to a lot of the people in the space and using similar risk parity strategies as well. And that's something that we're definitely going to dig into later on. And it's one of the main reasons we wanted to speak to you among others. And one of those is you've got an incredibly interesting background. So I think it's a good juncture to sort of speak about that, get a better idea of what you do on a daily basis as well. If we take it back, I think one of your first roles in finance was when you were hired at Oliver Wyman, which is an advisory firm for any of the listeners that don't know it. And you focus on the consultation of risk management for both global banking firms and insurance clients as well, as far as I'm aware. So I actually just sort of charting your career sort of prior to the interview, it seemed that there was a specialism in risk and the investment application of risk as well. Is that an area of sort of keen interest for you, or have I read that wrong?
No, that's correct. And it extends obviously to investment management as well. Really at the end of the day, when you're building a portfolio, you're allocating risk and you're trying to generate a consistent return by being thoughtful about allocating risk to reliably different drivers. And so it's interesting at Oliver Wyman, the firm became well known for pioneering this concept. At the time, they called it RAROC, risk adjusted return on capital. And the idea was to help global financial firms understand the risk adjusted return of their various business units so that they could allocate capital more efficiently. That actually sounds pretty familiar. That's basically what I do today in the investment world. And so that was where I first got exposed to this notion that in order to understand the quality of a portfolio, it's not just a focus on return, but it's actually the combination of return and risk that matters. And the way that you achieve the highest levels of return relative to risk is you understand the risk of any given decision and you try to combine those risks in a way that maximizes diversification. And that's the case if you're managing a global financial organization. It's the case if you're structuring a portfolio of different return streams. And so it was a very natural transition for me to go from there to Bridgewater. And it was quite exciting too, because frankly, building models to understand the risks of financial, businesses is less exciting than what I get to do today, which is really allocate to basically any return stream out there that I think can offer an attractive return and really understand the drivers of that return and the risk associated with that return and try to maximize diversification across a range of those types of strategies. And that's a pretty fun challenge. And Bridgewater was a great place for me to first sort of get an introduction to that investment world. I can't imagine really a better place to do that. And then today, in my current role, I get to expand the range of strategies and return streams we can allocate to, but basically to anything out there which we think can reliably make money for our clients.
Yeah, okay, absolutely. Well, you mentioned Bridgewater there. I think it was around a 10-year stint that you spent there, both as a senior client advisor and senior investment associate. And as you referenced there, probably one of the best groundings you could have possibly had in the asset management space. It is one of the largest and most sort of high-profile hedge funds in the world, of course. So what was the focus of your roles there at Bridgewater? Was it more about consultation, meeting with clients, or not? What were you doing on a daily basis?
I started in the research group, and then I really focused on working with our clients. So Bridgewater was unique in that they took investment professionals and they put them in the seats of client relationship managers. And the goal was to take the insights we had at Bridgewater and apply those to the major strategic challenges that our clients were facing around portfolio construction or manager selection or asset liability management, and deepen those relationships. And I think that was something that Bridgewater did exceptionally well, was build these strategic partnerships with large, sophisticated institutional investors, and I really enjoyed being on the front lines in trying to further that goal of deepening those relationships.
Yeah, absolutely. Yeah, that's a really interesting distinction actually, because you might imagine that it was, sort of a relationship management role, but actually you're an investment professional, and therefore I guess you're tasked with coming up with sort of bespoke investment solutions for some of these massive clients.
That's exactly right. So I was basically a consultant to those clients. And obviously my primary role was to manage those relationships on behalf of a firm that had a series of investment products. And so there was definitely a sales aspect to my role, and just a general client service aspect to my role. But the part of my role that I enjoyed the most was problem solving, as that type of strategic dialogue really around those strategic challenges that large allocators faced.
Yeah, absolutely. And those clients, they could go from sort of family offices, as far as I'm aware, right through to sort of $100 billion mandates. Is that right? Was it quite a diverse array of clients?
It was, although they were all large in size. So Bridgewater worked with the 300 largest institutional investors in the world. So that includes some multi-billion-dollar family offices, pension plans, sovereign wealth funds, endowments, those types of institutions.
Yeah. Okay. Got it. Well, if we focus in on Bridgewater and just kind of why it is a high-profile firm, I mean, I guess that's not least because of the founder Ray Dalio and his principled-based approach. He's said to have used this to foster an idea meritocracy, which would become the framework for Bridgewater's management philosophy. So, how would you describe the culture at Bridgewater? How unique do you think that guiding philosophy is?
It's very unique. It's one of a kind, in fact. I've never really experienced anything like it. The core tenets of the philosophy is seek truth through radical transparency. So there was limited hierarchy at Bridgewater. The idea was you wanted people to surface ideas, good and bad, from, all the way from the intern to the person that'd been there a long time. You want people to be constantly poking holes in whatever idea it is that you've come up with, because that's going to ultimately result in better decision making. And you also, as an individual, want to be hyper aware of the mistakes that you've made and why you've made them. Maybe it's just a capability issue. There are certain aspects or certain roles that you're not suited to. Maybe it's a function of a bad process. And so you can redesign the process, but you're not going to get better unless you really stare at those bad outcomes and figure out what caused those bad outcomes and make adjustments. And so that environment was an incredible environment for me to learn in and also personally grow. So I feel like, we used to joke at Bridgewater that it was like dog years, so like you're there a couple of years, it feels like you were there 14 years. And that because it is a very intense environment, but I'd say the aspect that people miss about Bridgewater is it's a group of really talented people who have signed on to operating in this way and holding each other accountable. And when you find talented people and you put them in that environment, you can accomplish pretty extraordinary things.
Yeah, absolutely. It does sound intense. And I mean, you were there, I think I said a moment ago, for around 10 years. Is that actually quite a long time to stay with Bridgewater? Is there a lot of sort of burnout or?
Yes, in dog years, it's a long time.
Yeah. Well, exactly. Yeah, you were there the majority of your life in dog years.
Yes, that's right.
Yeah, interesting.
It's a very, it is an intense place, but I think it was such a foundational experience for me. Foundational from the perspective of understanding investments and how markets function. Foundational in terms of the relationships I built. Because you're in this environment together and you have shared values, you find that you develop very close friendships. So it's a very tight-knit community. And then it was also very foundational in terms of the principles by which I operate my business today, and I orient myself to different relationships. It was really, I'm very thankful for the experience. It was at the end of it, it was time to move on. I was ready for new challenges, but I'm very thankful that I had the 9 years I did at Bridgewater.
Yeah. Okay. Well, to sort of segue into what you're now doing at ARIS, what key lessons did you take and are now applying sort of on a daily basis with your new firm?
Be humble. So this is an industry where people speak with unjustifiable certainty about what's going to happen. Nobody really knows, you know, and everybody likes to talk about the calls that were right, but far more calls are wrong, or at least probably half of the calls are wrong. And so when you're trying to reach a certain investment objective, it's not about what trade should you be in, or what exposure is the right exposure to be in. It's about building a portfolio of lots of individually attractive return streams that are reliably different. And that's really, that diversification is how you achieve your objectives with greater confidence. It's not about trying to pick the right thing to be in at that point in time, because that's a very difficult challenge, and you might be right some of the time, but you're not going to be right all the time. And concentration, while it can create a lot of wealth, can actually destroy a lot of wealth. So that was one aspect that I took away. And at Bridgewater's got 1,500 people, 40 years of history, some of the smartest people you ever come across, essentially unlimited financial resources. And they're right about 55 to 60% of the time. So that's the edge that Bridgewater has with all of those positive attributes. So I'm personally very humble about my ability to anticipate what's going to happen in the future. And so I want to make sure that, I will lean into things, of course, but I want to make sure that I'm not taking undue risk on any one decision or bet. That's critical. So I think the very best investors like Bridgewater are thinking, about how to generate return, but they're thinking as much, if not more, about how to stay in the game, how to survive. And you survive by recognizing you're going to be wrong a lot. You're going to be surprised a lot, and you have to build a process and a portfolio that can withstand the inevitable surprises. That was probably one major takeaway from Bridgewater. I think with regards to managing money, that was probably the biggest takeaway. I think then, in terms of how to think, how to approach, building a business, I think really, embracing the bad outcomes and learning from them and being open and honest with one another, I think is also a critical aspect of evolving very quickly and learning very quickly and being competitive in a hyper-competitive business.
Yeah, I can imagine that radical truth and transparency sort of element and takeaway from Bridgewater has served you extremely well since 2014 when you founded ARIS with Alex Shahidi. I ask most people that we speak to if they founded a business to give me sort of the mission statement or the primary objective for that company. I mean, if you could describe that for us, what do you think it would be?
Our objective is to utilize high quality investment insight from the smartest investors in the world to generate consistent and attractive returns for our clients with minimal downside risk. And so we have built an organization which seeks to find the very highest quality return streams, but then also think very critically and thoughtfully about how to combine those return streams in a portfolio to consistently meet our client objectives. And that challenge is ongoing. It's never ending, right? Because there are basically a countless number of ways to make money out there. And so, we want to find the very best investors globally and thoughtfully allocate to them and create portfolios around those return streams.
Yeah, okay. And just to pick up a point there and kind of get into the nuts and bolts of the business, are you an asset manager? Are you managing money on behalf of these people, or are you a conduit to kind of push money to the best external investment solutions you can find, or is it a bit of both? How would you describe that flow?
It's a bit of both. Say we primarily allocate to third-party managers, but in cases where we find that we can create a better solution, we will do that. So right. I'm sure we'll talk at greater length about our ETF, but our ETF was an example of us creating something where we didn't see that thing exist already. And so we have been for a number of years implementing risk parity concepts in client portfolios, utilizing third-party managers, whether it was specific risk parity managers or allocating to indices in order to create a more balanced asset allocation. And what we found is that we could achieve a better result by packaging it up into a fund, and better on several dimensions. Better in terms of it was more diversified than what we can do utilizing the existing menu of funds available to us. It was more cost efficient than we could achieve by utilizing those funds. It was also more tax efficient than we could achieve by allocating to third-party managers. So in that case, we felt like there were sufficient, there were many reasons why it made sense for us to create our own solution there. In other cases, if I'm thinking about how do I allocate to private real estate as an asset class, we're going to use third-party managers because there are always going to be specialists that are better at managing an apartment building, for example, than we're going to be.
Yeah. Okay. And on that latter side of the business and kind of finding external solutions, you referenced deeper due diligence on your website and the ability to identify the top 1% of active managers. How easy is it to identify the top 1% of active managers? It sounds quite a lofty goal. Is that because of the networks that you've built over the course of your career? Like how do you have access to these top managers, whereas other companies and your competitors might not?
It's multidimensional. So first, you have to have scale enough for those managers to want to give you access. So at our size, today we manage about $20 billion. That's a good size because it gets us access to just about any manager that we would like to allocate to, but it's not so large that we don't get enough capacity for our clients in order to meet our allocation needs. So that's just a starting point to get in the room. And then I think the more important aspect is that we've obviously evaluated thousands of managers over the years. So there is a pattern recognition to identifying who is likely to continue to generate attractive returns, who stands out from their peer group, in other words, who has real alpha potential. And then there's also other values we look for in managers. So I referenced this earlier, but it's not just about being smarter than your peers, but you also have to be humble and be thoughtful about how you take risk and cynical about the world and recognize you're going to be surprised a lot and build a process around that. We also want to see values like investing in your own strategies, closing strategies so that you don't get too big, and preserving quality. So emphasizing returns over, growth of the business, because ultimately this is, we want to allocate to those return streams that are most attractive, not just the largest, most well-known firms. There's also building a network of really smart investors with whom we share ideas. So we learn a lot, frankly, from our clients. So I think we have some of the most sophisticated clients around. And so many of the ideas get surfaced directly from them, or they might be, a VC general partner or a really fantastic real estate investor. And so we can triangulate our read on a particular manager with those practitioners that are in the space that would know these individuals by reputation and by experience. So that's critical. I've also been able to leverage my relationships from when I was at Bridgewater, where I worked with a lot of these CIOs of big endowments and pension plans. And we triangulate with them and get a lot of ideas and do a lot of collaboration with them as well. So it's multidimensional in the sense that we, the network extends not just to investment managers, but to asset allocators. And it's an ongoing challenge to find the very best. But I think over time, the more time you spend in these various areas, the more you get a sense for who the best players are. And of course, you're going to make mistakes, but as I alluded to earlier, you constantly focus on, when you get outcomes that are not ideal and what you can take away from it, and you try to get smarter. And I think over that time frame, we've been able to cultivate relationships with, ideally, we would like to to say the top 1%, but that's an ongoing challenge, and we continue to investigate new asset classes and new strategies. And so, that's more of an aspiration, but I think we can get close to that aspiration over time.
Yeah, absolutely. I guess, and you've alluded to it already, these managers that are kind of acting on behalf of you for your clients, I guess, need to align in some way with your own investment philosophy and kind of top level thinking, if not the nuts and bolts of your strategy.
That's actually an interesting point, because what ends up happening in a lot of cases is, managers might be closed, but and we ran into this at Bridgewater too. We were closed for a number of years, but you're closed, but you make accommodations for clients you want to have. So the luxury you have when you're closed is that you can be very selective about who your clients are. And so I've found that if we can demonstrate that we're good partners and we think in similar ways, I come more from a hedge fund background, more from an investment manager background. So I probably have more similarities to those investment managers than I do to your typical investment advisory firm. And so I think we've been able to build relationships as peers and on a shared set of values. And that has allowed us to get access in certain cases where others couldn't. So that's an important point. And then what's really interesting is a lot of times those investment managers become our clients, because we can help them access things that they aren't experts in. And again, it's like this self-reinforcing ecosystem I think we've been able to develop.
Yeah, great. And I want to get into ARIS's sort of investment thinking, kind of as a firm, how you think about investments, because obviously it's completely influenced the product you built. We've already referenced the ETF, and we'll explore that in greater detail shortly. But also, as we say, it needs to align it somewhat with certain clients, and that actually helps you get access to interesting clients as well, which actually isn't a point that I'd considered previously. So that's really interesting. And asset allocation just broadly seems completely crucial to ARIS's approach. And to be, I guess, more specific than that, a truly balanced portfolio. That's something that's referenced on your website. What do we mean, first of all, before we get into that, by a truly balanced portfolio?
The term balanced portfolio is commonly used, but it's interesting. If you look at what that usually means, it's like a 50-50 stock bond mix. It's not very balanced, because the 50% in equities is very, very volatile, and the 50% in bonds is not very volatile. And so that's really just a watered down equity portfolio. It's in our view, that's not balanced. It's not balanced to different economic drivers. So what we mean by balanced is find things that have reliably different sensitivities to different economic outcomes, and then have a more equal risk allocation to those things so that they matter roughly the same amount to your overall result. That's how you're going to get a much greater benefit from diversification. I'd say that the balanced aspect applies most directly to public markets. We also spend a lot of time allocating to hedge funds, to private markets. There, I think it's more about finding things that are reliably different. So thinking about the underlying beta that might be inherent in a particular private market, and what environments does that do well and poorly. Thinking about a strategy that a hedge fund might be implementing, in what environments does that do well and poorly. And always having that lens of, I don't want to be too biased to one economic outcome, no matter what I'm allocating to, and building a portfolio such that, again, that you can generate those consistent returns regardless of environment. That's what we mean by truly balanced.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
Yeah, okay. Well, if we focus at least for a second more on public markets, and you mentioned 50-50 there, I guess the typical sort of traditional portfolio balance is that 60-40 equity bonds or fixed income, or more safer assets on the 40% side allocation, is one that I guess is described as actually sort of fundamentally flawed on your website, and I completely get why that is. And Actually, a really interesting stat, again, that you reference on your website is that this correlation between the traditional 60-40 allocation and a portfolio that is 100% invested in equities is roughly 98%, which shocked me, actually. I mean, I knew the correlation would be high, but that high was surprising to me. And I think would surprise most investors, particularly participants in the retail space. Why do you think that is such a shock for kind of retail investors out there?
I think because we've been conditioned to think of that portfolio as being well diversified. And when you say to someone that a well diversified portfolio is still 98% correlated to the stock market, so all you really have to do is look at what the S&P 500 is doing today to figure out how you're doing, even though you've got this much more evolved asset allocation, that is surprising to some people. But going back to the point I made earlier, it's not that surprising when you think about the fact that the 40 is invested in something that doesn't move much. So really the driver of your outcome is going to be that 60. Now it's less risky for sure than a portfolio that's 100% stocks. And so, you do have some downside protection in the sense that you're not fully exposed to the stock market, but you're sort of wasting space with the other 40, frankly, because especially today, the other 40 is probably giving you a yield that's between 1% and 2%. And so it's not doing a whole lot for you. It's not moving much. If you get a big surprise one way or the other, there's not going to be a big price movement and you're not getting much yield. So it really isn't serving the same role it would have, 30 years ago when interest rates were significantly higher.
Yeah, well, I mean, on that point then, a portfolio overweight equities, particularly since early 2009, will have served most investors incredibly well. So I guess we're going to sort of broach the topic of risk parity strategies here, but, is it hard to make the case to investors that they should be less overweight equities in an environment? I mean, we're on the longest bull run in history by some measures. If you think that it began on early, I think the 9th of March 2009, and then has lasted over 9 years and 5 months since that point. We beat the great equity outperformance seen in the 1990s as well. So, how hard is it to kind of get support for a strategy that isn't demanding massive overweight equity exposure in this current environment?
It's somewhat challenging, but I think after such a long, successful run with stocks, I think investors are interested in exploring other options to meet their objectives with less dependency on equities. So actually, I found that investors are more receptive to this than they've been in some time because you've had such extreme outperformance from equities. It's interesting though, these concepts, these risk parity concepts, they're not concepts that will that will blow you away over short time frames, right? These are things that work over very, very long time frames, and I'm talking decades. So, what I think you get out of a thoughtfully constructed risk parity portfolio is you can be highly confident you're not going to end up with a terrible decade. I cannot tell you that for 60-40 or a stock concentrated portfolio. There are plenty of examples.
Yeah.
The 30s were terrible to be an equity investor. The 2000s, which wasn't even that long ago, were terrible to be an equity investor. Stocks were negative for a decade in the 2000s. People have a short memory because they've had such a phenomenal run in the 2010s, but actually it makes more sense too. It's like, well, of course, you had a terrible decade, so then you had a great decade. I mean, these things, there's a natural ebb and flow to performance for any given asset, usually a function of the economic environment. So when you get these big surprises is when you get the big negative outcomes for much longer than people realize. So for example, the reason why equities were negative in the 2000s is because if you think about where we started the decade, you started in the roaring late 90s. You had the big run up in the tech market. And so you had these very lofty expectations for growth and earnings growth priced into equity markets at the end of the 90s. And then you had the slowest rate of growth since the 30s in the 2000s because you had the tech bubble burst and then you had the credit crisis. So that disconnect between what was expected in the pricing at the beginning of the decade and then what happened, that was a dramatic shift in actual conditions versus what was expected. And that's the reason why equities did so poorly. It's actually also the reason why bonds did so well in the 2000s, because bonds do well in a weaker growth environment. And you had very lofty expectations to start the decade. So you could tell that story for any decade. You could look in the rearview mirror and say, okay, well, of course, stocks did well in the 2010s, because again, you had a more pessimistic setup coming into the 2010s. And then you had a surprisingly robust market outcome, partially informed by a recovery in economic growth, but also partially informed by just tremendous stimulus from central banks, which was a tailwind for everything, frankly. And so the beauty of risk parity is I don't have to guess. If I'm trying to meet my long-term liabilities, whatever they are, saving for retirement, paying my pensioners, having a perpetual college endowment and being able to cover tuition and be able to do the things I want to do as a university, those long-term liabilities are much more reliably met with something that is going to do well over a given decade. The thing that crushes you in this business is when you get a 10-year period of negative returns. That is tough to come back from. And it's the reason why the public pension universe in the US is chronically underfunded, even after this phenomenal decade, because of that hole they were in the 2000s. So that's I think the power of a risk parity strategy. It's not something that I'd measure over a year. It certainly can help in periods of time like Q1 of 2020, but it's really about how do I reliably meet my objective over longer timeframes. And we believe that it's critical to be diversified, and especially now, given the range of potential outcomes moving forward.
Yeah, no, absolutely. I completely agree, particularly in this current market environment and kind of where we're headed maybe over the next 12 months. And I want to get into the efficacy of the strategy now and over that time period by looking ahead. But before we do, can we just sort of, for anyone listening in that isn't familiar with the concept or isn't completely au fait with a risk parity strategy, can we just explain the basic principles of this approach?
Sure. So there are two, I think, core aspects to risk parity. Number one is that assets will give you, over time, they will give you a return above cash. So you can think of that as the risk premium you receive for taking your money out of the safety of your bank account. You need to be incented to do that with a risk premium or return above cash. And you can get risk premiums in a variety of different assets. You can get it in treasury bonds, you can get it in stocks, you can get it in inflation indexed securities, you can get it in certain types of real estate. Basically, any series of cash flows that you invest in, the price you pay today will embed a risk premium. That's how you are incented to take risk. So that's the first core piece. But then the other piece is that you can adjust the risk and return of any asset so it is very similar. So take, for example, bonds. Bonds come prepackaged in a pretty boring, low risk, low returning form. So if you buy the Barclays aggregate, you're getting maybe a 6-year duration exposure. And as I mentioned, it's yielding 1.5%. And its volatility is maybe 5%. Its annual volatility is maybe 5%. You can actually increase the risk and return of that exposure by going further out in terms of duration, taking on more interest rate risk. That will raise the return profile, that will raise the risk profile. You can further raise the return risk profile by adding a little bit of leverage, maybe using futures or other derivatives, or there are a variety of ways to do that. And essentially, you can turn your bond exposure into something that looks a lot more like your equity exposure from a risk and return perspective. By making that shift in perspective, it unlocks tremendous potential. Because now, instead of being forced to concentrate in equities, the high returning asset class, because you need to generate high returns, now you can allocate to any asset class after that adjustment at the same level of return and risk, at an equity-like return and risk, and really take much fuller advantage of diversification. So you go from a portfolio that's essentially one asset, the conventional approach, to a portfolio that's maybe 4 or 5 assets. That is a much more diversified mix. And it actually allows you to capture that risk premium that is inherent in all of those assets much more consistently.
Yeah, and just listening to you there, you're even saying return and risk is kind of one thing. That they have to be viewed as one and the same, rather than return and risk as two individual factors or investment metrics. Is that fair?
Yeah, that is.
Yeah, and it's sort of key to the strategy. You mentioned leverage there. You've kind of got the option of employing a bit of leverage, which makes a lot of sense. Are you able to sell short? Is some of the portfolio able to be sold short to kind of optimize returns for the overall mix?
I think there are probably some strategies where there's a short component, but the typical implementation of risk parity, it's a long only strategy. It's about how to combine different assets in a more diversified way.
Yeah. Okay. Well, in kind of researching the strategy beforehand, I wanted to look out for people that are perhaps negative on the strategy. I think that's where you tend to learn more. And I've certainly come to realize it's an extremely sort of compelling way to at least look at the markets and potentially invest your money. But when two asset classes, and I'm thinking about equities and bonds here, are sold off simultaneously to a significant degree, you see a lot of sell side and news reports, and what almost seems like an inevitability. I mean, you see it across financial media. They tend to blame the actions of risk parity strategies for that outcome. Do you think there is a negative bias, particularly in the institutional space, perhaps, that exists against these types of strategies?
It's interesting. A few years ago, in 2013, everybody loved risk parity. It was a very popular strategy because it did very well during kind of 08 and then subsequent to 08. It did very well. And so it wasn't just Bridgewater. There were a number of firms out there, AQR and others, that had a lot of success raising risk parity assets. And then 2013 hit, and 2013 were one of those environments where risk parity did poorly. It was down probably mid-single digits, depending on how you're implementing it. And that was an environment, if you recall, where the U.S. stock market was up around 30% that year. And so that type of dispersion between this strategy, which was sort of build all weather, and I think people took that to mean, oh, it never loses money, but every strategy loses money during certain periods of time. And so I think investors were disappointed because there was such a big dispersion between what they were used to and comfortable with, the more conventional equity-oriented approach, and what risk parity did that year. And that's when I think the confidence in risk parity began to wane a little bit, because there was this experience that didn't quite make sense to people. I can explain it, but I think for people that were less familiar with the strategy, that didn't quite make sense to people. It wasn't something that just made money all the time, which, by the way, there is nothing that just makes money all the time. And then you had this kind of stretch from 13 to 15 where there was a pretty significant amount of underperformance from risk parity. And so actually certain firms went out and changed the name of their strategies. So it became a dirty word, risk parity. There was a lot of negative attention to it, and certain strategies changed their name to, balanced risk premia or something that was, more, that wasn't specific to risk parity. And even though they were the same strategies. And I think that's when you started to see more negative coverage of it. And even to this day, I think that the coverage is less negative now. But I think even to this day, there's a lot of misinformation about what risk parity is. And I think there's an impression that it is a leveraged bond strategy. And certainly there's a portion of the strategy that is typically in leveraged bonds, but that's just a portion. It's not a bond strategy, it's a risk parity strategy. So we want to have a material allocation from a risk perspective to bonds, because bonds, they do give you a risk premium. You can see it in the steepness of the yield curve, and they do reliably do well in certain environments like Q1 of 2020 or 2008, when you get these big negative growth shocks. Bonds do really well. And so you want that diversification in the portfolio. You don't want the portfolio to be dominated by that. So it's one component among many. but I think there's this impression that, well, risk parity, is doomed because interest rates are so low and they have to rise. And so that's kind of the narrative I see out there. The other false narrative is that as soon as stock and bond correlations become positive, this strategy is destined to underperform. And that's actually not true. I think you have to understand why it is that correlations move around, not just between stocks and bonds, but between assets generally. And stocks and bonds, it's an interesting example, because if you look at the correlation between stocks and bonds over the very long term, if you look over 40, 50 years, the correlation is pretty close to zero. But you've gone through periods of time like the 70s and the 80s when the correlations were very positive. And you've gone through periods of time like the 2000s and the 2010s where the correlation's been very negative. And so you might wonder, well, if I'm trying to build a portfolio, how do I build a portfolio around a correlation that's inherently unknowable and unstable, and it's been significantly positive and it's been significantly negative? And this is actually a flaw, I think, with the conventional approach, is that you should not be designing anything around some static notion of correlation. Correlations always move around. And correlations aren't some sort of static characteristic of the asset class. Correlations are just an outcome of relationships that exist between assets and economic drivers. And so we find it to be much more reliable to actually structure our portfolio to build a risk parity portfolio around economic drivers. And so, for example, when growth is strong, I'm highly confident if growth surprises the upside, good for stocks, bad for bonds. And the reverse is true. If you have a big negative growth surprise, good for bonds, bad for stocks. That's an easy to understand, very intuitive, very reliable relationship. And so when we think about building portfolio, we want to have similar risk to things that do well in a rising growth environment and similar risk in a falling growth environment. And so that's how we think about it. We think about it in terms of these environmental drivers. In terms of that correlation example I gave you, that correlation has fallen out of the economic relationships of assets and which economic drivers have been more pronounced. So in the 70s and 80s, the biggest driver of relative asset class performance was inflation, not growth. And when you get an upside inflation surprise, it's actually bad for both stocks and bonds. And when you get falling inflation, it's actually good for both stocks and bonds. So the fact that inflation was the dominant driver in that period actually was the reason why you saw a higher correlation between stocks and bonds. And in the more recent couple decades, it's been more a function of growth. You've had these big, you had the tech bubble burst, you had the credit crisis, you've had these big swings in economic activity, and inflation's been relatively benign. So it hasn't been much of a driver. And when you have big shifts in growth expectations, that's going to cause a negative correlation between stocks and bonds. So those environmental drivers to us are the more reliable things to understand and structure a portfolio around. And it also helps explain, some of the dynamics you see between stocks and bonds. So the things that are going to cause stocks and bonds to be highly correlated, it's not necessarily a bad thing for risk parity, because the other component of risk parity besides stocks and bonds are inflation hedges. And so in that environment where inflation becomes more pronounced and it's a concern and it's bad for stocks and bonds, if you have inflation hedges, you might actually do a lot better than the conventional portfolio. Because remember, what is in the 60-40? It's stocks and bonds. So the 60-40 portfolio would have done awful in the 70s. It probably would have trailed cash for over a decade, because those assets are not biased to do well in a rapidly rising inflation environment. The types of things you would need in that environment would be things like commodities or TIPS exposure. And we have a significant allocation of those things, actually a similar risk allocation of those things that we have to stocks and bonds, traditional stocks and bonds. So that is, I think, critical to understand. It's what would cause the correlation to be high between stocks and bonds. And a persistently high correlation is probably because you're in a rising inflation environment where those inflation hedges are going to be a big benefit. And I think we'll actually be in a risk parity strategy. You're going to actually be better conditioned to weather that rising inflation environment than you would be in a concentrated, equity oriented portfolio.
Yeah, I mean, to view the strategy in a vacuum and not appreciate the external sort of environmental factors certainly seems misguided. So I completely get why you put such an emphasis on them at ARIS. And I mean, one more question then, I suppose, around risk parity and its efficacy within the current environment. Do you think managers or risk parity managers specifically missed a long-touted chance to kind of prove the value of this approach? I'm not saying it needs to be proven, but I guess, if we were to think that the last 12 months were relatively optimal for this strategy, have they now got another 12 months, another 6 months, whatever you think that time frame might be, to make some returns with this strategy?
So the other important aspect of risk parity, is what causes a period of time like 13 to 15, which is meaning a period of time where risk parity underperforms. And then even in Q1 of this year, risk parity underperformed a little bit. It's driven by the tightness of the dollar liquidity environment. So in other words, when you get the central bank tightening liquidity, as they did in 13, when Bernanke announced he was going to, he caused the taper tantrum because he said he was going to start to withdraw support in terms of the quantitative easing they were doing. Or this year, I think what's happened is, even though the Fed hasn't raised interest rates, I think there's an expectation now, which is clear. It's pricing in an expectation in asset markets that they're going to be less accommodative than people thought, because you basically have this robust recovery underway now. So those periods of time where either it's Fed engineered, or you have a panic where people just rush to cash and have a preference for cash over assets. Those kind of periods where cash is king and people have a preference for cash over assets, that tends to be the periods of time when risk parity underperforms. Because again, you're depending on this relationship when I describe risk parity, whereby assets on average outperform cash. So if you have a period of time where cash starts to get more attractive relative to assets, that's a headwind. Those periods don't tend to be very long lived. So, and they tend to be followed by very, very good periods of time to be investors in risk parity. I think we are in one of those environments where the central banks in general are going to be supportive. You're in a reflationary environment, and you're going to have plentiful dollar liquidity. And in that environment, owning assets is a good thing to do. But I think you have pretty significant risks. I don't know what's going to happen with the growth or the inflation environment. We certainly could have higher inflation here. You could certainly hit some hiccup in terms of the growth trajectory. And those outcomes are impossible to predict. So I want to make sure I have assets that will do well, regardless of where growth goes, where inflation goes. But I want to own assets. And so I would say this environment where central banks are likely to continue to put their foot down, keep interest rates low, support their economies through, basically money printing and aggressive stimulation. That should be an environment that's generally good for assets. But on a relative basis, some assets may do much better than others. So I want to make sure I'm risk balanced across assets that can do well across different economic outcomes. So I think, so in short, I think this is probably a good environment for risk parity. But I think it is important to understand that, those environments of tighter liquidity are the things that you're primarily exposed to in terms of risk with risk parity, not economic surprises, but those kind of tighter liquidity environments, and they tend to be short-lived.
Yeah, absolutely. And like we mentioned, or you mentioned towards the beginning of the interview, this is potentially a strategy you want to consider over sort of 5 to 10 years, rather than perhaps my slightly unhelpful question, 6 to 12 months. But it is interesting to know what's going on in the short to medium term. So, okay, well, let's finish the main body of the interview by looking at ARIS's Rpa Risk Parity ETF. So essentially everything that we've talked about today is sort of crystallized essentially within this ETF product. Is it the only risk parity ETF strategy out there?
It is, as far as I know.
Yeah,
I mean, surprised. When we started, I mentioned earlier that we didn't see a product out there that met our needs, and so we created one. We were really surprised that there weren't any other risk parity ETFs.
Yeah, it was with similar surprise, having done a bit of research, but I was conscious I wasn't going to exhaustively be able to sort of comb the internet for every ETF product out there, but I couldn't see another one. So that does obviously give this product quite a USP and differentiation from what else is out there. So that's interesting for the listeners to know. And could you describe the current makeup? I mean, it doesn't have to be, you don't have to give us specific weightings or anything like that, but the ETF at the moment, where are you most overweight? Where are you most underweight?
Well, we take a more long-term static approach to risk parity. And so we're not explicitly under or overweighting specific asset classes. We have roughly equal risk allocation to 4 asset classes, which are equities, global equities, commodities, treasuries, and TIPS, or inflation protected securities.
Yeah. Okay. So, yeah, I guess if it's considered over that longer term period, then to what extent, and you can say none at all, is sort of sector allocation within the equity segment of the portfolio considered? Are you considering sort of geographical sort of representation within the portfolio, again, predominantly within that equity segment of the portfolio, or because it's considered over a much longer time frame, are those sorts of things not considered?
Within equities, we take more of a market cap approach. It's not pure market cap, but it's close. So we allocate to broadly diversified index exposure in the US, in non-US developed, and in emerging markets. And when you look at the mix of those 3 allocations, we actually use Vanguard funds for the 3 allocations. We do have a slight tilt to emerging markets relative to a pure market cap approach. And the idea there is that emerging markets, we believe, offer you an incremental risk premium and diversification relative to developed markets, which we think is valuable. And on a longer term basis, we think they're going to continue to grow in terms of their share of global economic activity and global market cap. So it's also a view on kind of the longer term trajectory of where the broad market cap is likely to land in terms of different country exposures. But we do not take specific views on individual sectors or try to take some sort of sector risk balanced approach, which I know some risk parity strategies do. The one exception in terms of sector exposure is that we do very explicitly allocate to commodity producer equities as part of our commodities allocation. And there, we actually designed a custom commodity producer index that essentially got as close to the underlying commodity prices as possible, because we wanted to have the best possible inflation hedge utilizing those commodity producer equities. So we created that index, and when you look inside the ETF, what you'll find is you'll see a number of individual equities that correspond to that commodity producer index we created.
Yeah, interesting. And that's just an index. That's not a tradable product.
It is not a tradable product, no. So it's something that's part of our index that the fund tracks, but there's no standalone ETF that would implement that strategy, at least not today. Yeah,
interesting. And how often is the Rpa ETF rebalanced?
Quarterly.
Yeah. Okay. So fairly dynamic. I mean, what can you give us in terms of performance there? I don't want to be too specific on timeframes, but over the past 12 months, for example, has the portfolio performed relatively well?
Yes, it has. I mean, last year was a great example because you had essentially a full economic cycle condensed into 12 months, maybe even less, depending on how you define that. And so in the first quarter of last year, the strategy was down about 4%. This was the direct result of having exposures that did very well when you had that negative economic surprise. So gold and treasuries and TIPS did well, and the equities and the industrial commodity exposure via the commodity producer equities did poorly in that period of time, but they offset to more or less, just down a shade, down 4%. And then the portfolio rallied along with global equity markets through the remainder of the year, and finished the year up just a little bit above 19%. So that was a good example of the benefits of diversification. It was a much smoother ride through very different economic environments with an overall result that I think was something we were very pleased with.
Yeah, I mean that's pretty significant outperformance there. I guess I want to finish this part of the interview by opening it up for the listeners. We've got a lot of UK listeners, but also nearly half of our listeners are based in the US. Is it that latter portion of our listenership that will be able to get access to this portfolio rather than everyone?
I believe we've received a lot of inquiries from overseas investors, so I think there are ways to access the CTF overseas. So I know that we have a lot of European and Asian investors, but we are thinking about creating a UCITS or something that would be, I think, more directly tailored to the to our overseas clients. So that's something in development.
Yeah, great. Okay, something to look out for then. All right, well, that's the perfect point to end the main body of the interview. Now, we've got a sort of generic list of questions. So the idea is that they're applicable to everyone that we speak to. We speak to investment managers, CEOs of companies, and shorter-term traders as well. So these questions will feel relatively generic, but hopefully just a light-hearted way to end the episode. And this is our quick fire question round. So feel free to answer in as little as one sentence or even one word if you like. The first question, in your opinion, what is the top mistake investors make?
I think it's failure to appreciate the benefits of low correlation return streams. So in other words, it's an overemphasis on the return and not enough of an emphasis on the correlation benefits, the diversification benefits of a particular strategy.
Yeah, okay, absolutely. Question 2, where do you go for investment or economic insights? Do you read specific publishers, for example?
My favorite publication is the Bridgewater Daily Observations. So Bridgewater puts out a daily research piece that I think is excellent. So that's probably the only thing that I read religiously. There are a number of other things that I'll follow, but that I think is probably the most consistently high quality piece that I read.
Yeah, okay, great. So question 3, what is the most memorable moment from your career to date?
Starting my own business. So the day that we launched, it was like it was a Jerry Maguire moment because my business partner Alex, he was at Merrill Lynch. He was running a large institutional consulting practice there, and so he had to basically put in his resignation, and I was waiting for him in our new office down the road. And he arrived there, and we basically manned the phones for the weekend, calling all the clients and convincing them to come over to our new firm. So that was probably the most memorable step.
Yeah, well, I can imagine. Okay, well, a penultimate question then. A top tip for your younger self?
Ask more questions.
Yeah, good. I think we've actually had that one before. Yeah, makes a lot of sense. Question 5 then, what is an investor's best source of alpha? So if you had to narrow it down to one thing, where do you think the great investors derive their outperformance?
I think that the really exceptional investors have unique insight that allows them to see things that others don't. So they'll be able to point out things to you that seem really obvious, but that nobody else has ever pointed out to you before. And we've seen that common aspect where we learn something from the really exceptional investors, and they change our perspective on a particular asset class or a particular strategy.
Yeah, great. Okay, yeah, nice answer to finish on then. Well, it just leaves me to say thank you very much for joining us on the podcast, Damien. It's been a real pleasure.
Thank you for having me. It's been a lot of fun.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.